right? The government wants to spend more, but the Bank of Japan, which is the buyer of last resort that owns half the market, they're trying to spend less. Investors are looking at the supply and they're demanding to be paid more to hold it, right? Because it's more risky for them. They're like, I don't care what inflation does, pay me more interest. This is why the world's investors are betting against Japan with huge amounts of leverage. Check this out. You're looking at 18 years of hedge fund bets on the Japanese yen. This data comes from the CFTC, which is publishing actual disclosed positions by big hedge funds. What this chart is showing us is that when this line is above zero, hedge funds are betting on the yen. They think the yen will go up. When it's below zero, they're betting against it. So the lower this line goes, the more money is shorting the yen. Now look at where we are today. We're all the way down here, right? This is around negative 150,000 contracts. In dollar terms, it's roughly $11-12 billion of bet against the yen. But that's only what's visible. Most currency trading happens in private deals between banks that never show up in this data. So I can't show you that because we don't have it. But this might be just the tip of the iceberg. So what they're all doing right now is they're borrowing yen, they're shorting the yen because they're assuming Japan is helpless to stop this. Now the Bank of Japan sees all this, and what are they doing about it? Well, they tried to fight it. In April and May, Japan's Ministry of Finance spent $73 billion buying their own currency, the yen. And it worked for about 3 weeks. The yen went up, and then it went back down again. Then in June, the Bank of Japan increased rates to 1%, and the yen went down. One economist said that doing this while your economy still runs on cheap money is like tapping the brakes while keeping your other foot on the gas. You're going to burn through your brake pads, and the car's not going to. Now, Japan still has enough money for 15 more interventions of this size, but they're not using it. They're not using it because Japan has figured you cannot defend your own currency by buying it. Every intervention is just going to feed the short sellers more fuel. So if Japan wants the yen to actually go up in strength, it does not need to buy the yen. All it has is change where the money lives. And that is why Japan's policy is for its wealth to return to its homeland. So there's an official word in economics for money returning back home, and it's actually called repatriation. And here's how we know it's happening. Because for the first time in a generation, Japanese bonds are actually paying something. The 30-year bond pays about 4%, which means for the first time in 30 years, a Japanese pension fund or insurance company look at a Japanese government bond. Hey, maybe we should put our cash here instead, where we get a guaranteed yield at home in my own currency with no exchange rate risk. It's making sense for Japanese money to return back home for the first time since the